Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, U.S. stock futures falling this morning in the last full day of trading this week amid weakening economic data. ADP private payrolls for June coming in at negative 33,000. So 33,000 jobs lost, with the estimate calling for 100,000 jobs to be added last month. Investors are now looking to the June jobs report that is due out tomorrow for the latest read on the health of the economy and what it all means for the Fed. Plus, President Trump's tax bill running into resistance from House Republicans. Moderates and ultra-conservatives are threatening to defy the president and sink his domestic agenda as House lawmakers vote today on the Senate version of the multi-trillion-dollar tax bill. Within the bill, deeper cuts to safety net programs, a sped-up timeline for the elimination of clean energy tax breaks, and benefits for businesses with permanent tax breaks. Now, the bill also includes various provisions, such as a higher limit on the state and local tax deduction SALT, and then exemptions from taxes on tip incomes, and then additionally cuts to Medicaid spending. And investors are bracing for Tesla deliveries that is due out today. The electric vehicle maker faces uncertainty amid growing backlash against Elon Musk's role in the White House. The electric vehicle maker recently released the consensus number that it compiles from some 24 Wall Street analysts who expect about 386,000 vehicles delivered. That's down about 13% from 444,000 delivered in the second quarter of 2024. Let's get a check-in on U.S. stock futures. We're inside of 30 minutes until the start of trade here in the U.S., and we've got declines across the board here this morning. Fractional as they may be, take a look at the Dow, flat but barely to the downside right now by about 0.1%. The S&P 500, you're taking a look at that, lower by 0.1%. And the NASDAQ, that is pointing down by about 0.3% here this morning. Of course, a lot of time left as we're continuing to move forward in this holiday abbreviated trading week, but we've got some top stories that we're tracking here today, the last full day of trading. Our top stories today: the S&P 500 futures turning negative as Wall Street digests week's jobs data, and then additionally the private sector losing jobs in June, marking the first job declines in over 2 years. Eyes now turn to Thursday's jobs report from the BLS, and President Trump's tax bill facing Republican resistance in the White House and in the House of Representatives, rather, as lawmakers return to Washington to vote on the Senate version of the bill. Joining me now, we've got Jennifer Schonberger and Nez Ferre live from the NASDAQ, Brooke DePalma as well. So, Brooke, let's start with you, because we're seeing futures off their session highs, that after some of the weaker than expected ADP private payrolls data. What do we know here?
Yeah, stocks this morning hovering around the flat line as really investors try to digest what exactly trade talks could look out for and what exactly we could hear from the Federal Reserve next month as these tariffs take effect. If you take a closer look at that ADP report, we did see jobs in the private sector fall 33,000 jobs in the month of June. That was far less than what Wall Street had expected, a gain of 98,000, and also far less than the 29,000 that we gained in the month of May. Now, once again, this was the first month of job declines or job losses since March of 2023. And Neela Richardson of ADP, where this report is from, the chief economist there, said, quote, layoffs continue to be rare. Hesitancy to hire and a reluctance to replace departing workers led to job losses. If you take a look underneath the hood of this report, we did see those job losses led by three key sectors, including professional and businesses, services, also education and health services, in addition to financial activities. Now, one thing that the Fed really looks out for is also wages. We did see that for employees who changed jobs. We saw wage growth at 6.8%. We also saw for employees who stayed their job, we saw a wage gain of 4.4%. Important to note here that both of those wage gain numbers were less than the previous month. But the big deal here is that this ADP report is often a key precursor for the monthly jobs report from the Bureau of Labor Statistics. Jen Schomburger, I know you're standing by with more. Jen?
Yeah, hey there, Brooke. It was a pretty ugly report on that top line, wasn't it, from ADP? But that's not necessarily indicative of what we could see from the BLS report tomorrow. And that is the report that is really the gold standard, the one that the Federal Reserve pays the closest attention to. And while that ADP report did show a contraction, the BLS readings have been showing resiliency in the job market so far this year, albeit on a cooling trend. That cooling trend expected to continue for the month of June. 110,000 jobs expected to be created last month. That would have been a downshift from 139,000 created back in May. The unemployment rate also expected to tick up to 4.3% from 4.2%. Now, when you hear the prospect of that, it sort of sends up a warning flag that perhaps the Fed would be worried about weakening in the job market. But Fed Governor Chris Waller had cautioned earlier this year that it's really the speed with which the unemployment rate increases that would worry the Fed. So if we were to see a 1/10 of a percentage point uptick on the unemployment rate as expected tomorrow, and of course, we'll see what actually happens, that wouldn't be that worrisome. But if we were to see the unemployment rate tick up by 0.2%, 0.3% every month, then that would be more worrisome because that would indicate that there are layoffs. Elsewhere in Washington, we are paying attention, as you had mentioned, Brad, to that big, beautiful tax bill. That tax bill now facing hurdles in the House today, just a day after that legislation squeaked out of the Senate with a 51-50 vote, J.D. Vance acting as that tiebreaker. And fiscal hawks are really bulking at the price tag. The Senate bill comes in at $3.3 trillion, according to the CBO, and that's up from the $2.4 trillion that the House had sent initially to the Senate. And if you remember, there was a lot of arm twisting just to get that out of the House at that price tag level to the Senate. So no surprise here that a lot of the fiscal hawks feel that this is a bit irresponsible when it comes to the national debt. The House Rules Committee ended up passing the legislation out of committee early this morning. The House Rules Committee is sort of the gateway to the House floor. And this morning, that bill expected to be debated, paving the way perhaps for a procedural vote to move the bill forward. That remaining a question mark, though, here this morning, because Republicans can only afford to lose 3 votes. And right now they have over the 3 votes that they would need to pass this. So the House Freedom Caucus could end up sinking this bill. President Trump has no public events today, so I suspect he may be making some phone calls over to some of these House members to do some arm twisting. If the House, in fact, is not able to pass the Senate's version, it needs to make changes. They will need to reconcile that with the Senate, which means that lawmakers would be blowing past the president's self-imposed July 4th deadline. And
so let's go further into the tax bill. Inez, Trump's tax bill would actually end tax credits for electric vehicles in the coming months. What do we know there, and how will this impact EV makers? Noteworthy in this, Tesla.
Yeah, Brad, that Senate tax bill ending the tax credit for $7,500 on new and leased vehicles, that would end in September of this year. Originally, it was in 2032, so it is quite a rollback. It would also end the tax credit of $4,000 as well. Another one of the other tax credits. Look, advocates right now are going to House Republicans saying, please, you need to change this part of the bill. This provision cannot go through in the final law when it's passed. This is because it will severely impact the EV industry. You've had advocates that are saying that these tax credits have been huge for investments in the electric vehicle industry. It has been huge for jobs, accounting for about 80,000 jobs, according to one estimate. And if we take a look at what's happened to some of the EV stocks, I just want to pull up our Wi-Fi interactive chart so you can see. This is just from yesterday when we saw Tesla down 5%, Lucid also lower. But I'm going to pull up a year-to-date chart, and you can see that Tesla is down 25%, Lucid down 32% year-to-date. I mean, you're not just talking about the EV makers, you're also talking about batteries, about charging stations. This will affect the entire ecosystem. One one silver lining that we are seeing this morning for Tesla stock, as I pull up the extended chart to see Tesla right now up 5% after reporting their deliveries for the second quarter and their production numbers for the second quarter. Those second quarter production coming in higher than what the street had been anticipating. Brad.
And Brooke, in other earnings space right now, Constellation Brands missing on adjusted earnings per share on weaker than expected beer sales. We've been watching closely this one this morning. What did we learn from the report?
Brad, the stock right now flat as we make our way into the open. We're waiting to hear from a key call with executives at 10:30 this morning after the report came out last night. They do their call the following day. But if you look beneath the report, one key call out is the impact of the Trump's administration crackdown on immigration that really caught our attention. You see, Constellation Brands, Corona, and Modelo Brands has a key Hispanic consumer. They said that they have a very loyal Hispanic consumer to both those beer brands. And in their report, they said that there has been socioeconomic concerns that have impacted this past quarterly results. And that's because this group of people and beyond that have gathered less. They've gone to less gas stations and convenience stores and less public places. And that led to a 3.3% decline in volume growth for beer, specifically at Constellation Brands.
All right, we've been watching that one. We'll keep close tabs on it here, especially as it's just flat, barely to the upside. We'll track it going into the open here. Brooke, Inez, Jennifer, thank you so much. Well, July is typically a strong month for stocks, with the S&P 500 historically delivering an average return of 1.5% for investors. Since 2000, that makes July the third best month for stocks, trailing just November and April here. Now, here you're taking a look at where we typically see some of those returns net out, and you can see where September has some sluggishness, the most sluggishness in terms of historical performance since 2000. But one of the things that we can also consider during the month of July is both earnings and then additionally the types of volume that we typically have that is out of the system. And so ultimately you could see more of these swings or at least more complacency. And so with some of those earnings reports that typically do kick off the season, look out for names in the financial space. Look out for some of the early technological plays that are out there. Netflix, typically one of those that has been a stronger player over the course of 2025. And so if you do have the additive performance of those major behemoths at the same time as they are setting the tone for the rest of the earnings season, then July could be one that is set up for, once again, perhaps a repeating of what we've seen since 2000. But as a solid reminder, past performance does not always equal future results here. Coming up on Morning Brief, we count you down to the opening bell on Wall Street with stocks set to open in the red. All that and much more coming up. Here's a shot of New York. We have breaking news. Tesla reporting second quarter deliveries falling short of estimates. Yahoo Finance's Brooke DePalma and Jennifer Schonberger join me now with the analysis as we're seeing shares of TSLA still move higher pre-market. Brooke, give us a rundown of the numbers here.
Investors certainly pleased with these results, even though 2Q deliveries were just ever so slightly less than what the street had expected. Shares are up roughly as much as 6% in the pre-market, now backing down a little bit in the early hours trading session here. If you take a closer look, that number came in at 384,122, slightly lower than Wall Street's expectation there. If you take it into context here, that was far higher than what we saw delivered in Q1 at around 336,000. But this is also far less than a year prior when we saw vehicle deliveries in Q2 coming at 444,000 just last year. If you also take a look at 2Q production as far as vehicles go, we saw that number come in higher than what the street had expected at 410,244. Now, other model deliveries slightly less than expected at 10,394. But really, this comes at a time when Tesla is facing this growing competition from Chinese car makers like BYD, Bird there. And also you have General Motors, you have Volkswagen, you have BMW really looking to get in on this EV market here. We also heard this morning from Tesla that specifically within their Shanghai factory, they saw their first increase in vehicle deliveries in that market for the first time in a year. And so Wall Street certainly pleased with a bit of optimism here in early hours, pre-trading open.
Jennifer, I want to bring you back into this as well here, especially as we know that this is going to be critical on the EV mandate side. So on the EV tax credits that have been rolling off, but ultimately that's still a part of what has Elon Musk and Trump feuding publicly right now.
Yeah, Brad. I mean, once one of the president's closest advisors, Elon Musk, slamming that big, beautiful tax bill. And of course, we know that that tax bill is going to phase out those EV government credits by September 30th if the Senate bill passes. So that would be quite a rollback from initially 2032. And ostensibly, that takes away a bit of the incentive that makes some of these EVs affordable for Americans to purchase and could hurt Tesla's business. For that reason, President Trump thinks that is why Elon Musk has been criticizing the tax bill so much, even though Elon Musk has said that it's really the fact that it drives up the deficit and the debt is what concerns him. But the two have been trading barbs so much that it's escalated to the point where the president has now pondered publicly about doging the initial creator of Doge, Musk himself, saying that he doesn't think there's any human being on Earth that gets as much government subsidies as Elon Musk does, whether it's Tesla or SpaceX or any of his other businesses. And so that's certainly a shot across the bow there to Elon Musk. You don't really want to get on the president's bad side, right, Brad? Don't poke the bear.
Yeah, indeed. Brooke, Jennifer, thanks so much. And we'll see if President Trump lists his Tesla for sale as he had sparred when they were at the height of their feud and ultimately backed down, said that they would talk. But we'll see what transpires there. Jennifer, Brooke, appreciate it. Now time for some of today's trending tickers. We are watching Centene, big banks, and we're also watching Microsoft as well here. First up, Centene's stock is plunging this morning after the health insurer withdrew its 2025 profit guidance. The company cited lower than expected market growth and significantly higher than assumed patient sickness in the ACA marketplace as the reason for the decision. Centene also said it was seeing an increase in Medicaid costs that could significantly impact a key measure of medical expenses in the second quarter. The company is expected to report second quarter results on July 25th. Next up here, Microsoft is reportedly firing as many as 9,100 employees in its latest round of layoffs, according to the Seattle Times. That would amount to nearly 4% of the company's workforce. Earlier this week, Microsoft said the company's chief commercial officer would be stepping away for an 8-week sabbatical ahead of the rumored job cuts. Microsoft laid off roughly 6,000 people back in May. And finally here, Paramount agreed to settle a lawsuit from President Trump for $16 million. The president filed a $10 billion suit against the network in October, alleging that 60 Minutes' editing of an interview with then presidential candidate Kamala Harris amounted to election interference. CBS has said it aired a more succinct version of Harris's interview on 60 Minutes, and the settlement comes as Paramount prepares for an $8.4 billion merger with Skydance Media, which will require approval from the FCC. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Stock futures are lower this morning following that disappointing private payrolls report. Still, stocks are trading right now, causing speculation on Wall Street that markets could be in bubble territory. The rebound from the lows in April to fresh all-time highs at the end of the second quarter, sparking a jump in Barclays' irrational exuberance gauge, which actually measures the percentage of stocks in euphoric territory. It currently sits just above 10%, which has signaled extreme frothiness in the past. So what does this mean for investors? Joining me now, we've got a good friend of the show, Sam Stovall, CFRA Research Chief Investment Strategist. Sam, good to see you here this morning, and thanks for taking some time ahead of the market open. First and foremost, I would love to get your assessment of what is being dubbed and called this irrational exuberance, with us essentially still in this ballpark of some of the all-time highs that we saw notched earlier this week.
Well, good morning, Brad. Yeah, I think people are a bit concerned because we went through a very steep V-shaped decline and then recovery. Yet history actually says that that's typically what happens, because we went from a new all-time high to the minus 10% threshold in only 22 calendar days versus the more normal 80 plus days. That implied that this decline was going to be swift, shallow, and the recovery would be quick at hand, which is exactly what we got. Instead of the 4 months that we normally take to go into a correction and then another 4 months to get out of that correction, those numbers were essentially cut in half. And actually, because people are so concerned, I think that history again will remind us that we tend to advance another 10% following the recovery of the old high. So, while we can always see some sort of digestions of gains, I think the overall trend remains upward.
And so with that in mind, if we're looking at an overall trend that remains upward, what perhaps is the major kind of additive to the mindset, and how far out investors might be looking through some of the trade deal negotiations, through a bill that's working its way now back through the House, and then, oh yeah, we're trying to figure out exactly what companies might say during earnings season in the next few weeks here as that kicks off?
Sure. Well, I think that initial reactions are like dropping a ping pong ball on the table. The first response is the greatest, and then subsequent ones are more muted. And that's what we have seen regarding the tariff situation, regarding the one big beautiful bill, et cetera. And also because we had a worry that we were headed for recession, and bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. But because of the recovery, the old adage of prices lead fundamentals implies that maybe we're seeing a near-term bottom in terms of earnings projections. Q2 results are now expected to be up only about 2% versus the near 10% advance that was expected at the end of 2024. So I think with the bar set so low that we'll probably end up seeing actual results exceed end of quarter estimates once again, which will make the 63rd quarter out of the last 65.
You know, that's so interesting, and I was discussing this yesterday with a few of our guests, and would love to get your thoughts on this too, since you raised the fact that this earnings growth rate could be one of the lowest growth rates that we see since Q4 2023, according to FactSet, if it does come in at this 5% earnings growth rate for Q2 for the S&P 500. Can you make sense of the fact that we've got that in one hand, and then on the other hand, you've got forward 12-month PE ratio sitting for the S&P 500 at 21.9, which is above the 5-year and the 10-year average right now?
That's right. Well, I think your first thought is that FactSet's estimate for Q2 is above 5%. S&P Capital IQ estimates, which is what we use, is about 2%. So there is no FASB designated definition of operating earnings. Most people simply call it earnings before bad stuff. But still, the bar is set very low. And as my father used to say, rarely do you injure yourself falling out of a basement window. So I think we probably will be surprised to the upside when Q2 results are completed. But in terms of the PE ratio, you're absolutely right. If you look back over the many years, it is elevated, but I think that we're likely to see these earnings estimates increase as time goes on, in a sense, to match what happened with prices.
Sam, we're marching to the opening bell here. We got to leave the conversation there. Great to see you as always.
Thanks, Brad.
Thank you. That does it for Morning Brief, everyone. Much more ahead with Yahoo Finance. Opening bid starts next.